I think the Fed has lost complete control of everything except how much money they print. And now we're stuck here at $120 billion a month of QE. That's $1.44 trillion worth of what I call counterfeiting.
Please join us for our next live stream, Sunday, September 12th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, September 12th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. As always, if you're new to our channel or if you haven't already done so, please do subscribe, hit the bell to be notified of new updates, and give us a thumbs up. If you like what we do, we truly do appreciate your support. Michael Pento joins us today. Michael is the president and founder of Pento Portfolio Strategies and brings in more than 27 years of investment experience, along with being the portfolio creator and consultant for the likes of Delta Claymore's commodity portfolios that raised in excess of $3 billion. And Michael is also the author of the book, The Coming Bond Market Collapse. It's time to saddle up and silver up for Michael Pento. Michael, welcome back to SBTV. How are you doing?
Good to see you, Patrick, as always.
Glad to have you back, Michael. Appreciate the time. You know, earlier this year, we saw the 10-year Treasury move up to 1.74%, and that was about the same time that the Fed had started talking about yield curve control. And today, that 10-year sits pretty comfortably at around some 50 basis points lower. In your opinion, has the Fed implemented yield curve control, and why?
First, I want to say God bless you, and I hope we have a great interview. And I'm so happy to hear about your success. And we just always pray for the best for this country and for the market always, so for people's well-being. So, well, the Fed, I mean, let's be honest. I mean, I'm an honest person, so I got to speak honestly. I think the Fed has lost complete control of everything. They started with the hubris and arrogance to believe that they can manipulate markets and eliminate recessions and eliminate any downtick in stocks. That was the big mistake. And they started out with the Fed funds rate around 6%, at the turn of the century, year 2000. And now we're at zero, and we're stuck at zero. And I always remind people that we're at zero not because of COVID. We were on the way to zero in 2019. We lowered rates. The Fed, United States of America's central bank, lowered rates 3 times in 2019. So we were on our way back to zero anyway. The repo market was freezing up. Inflation was way below 2% the way they measure it, because they have these ideas that they can control everything, and they really have no control of much of anything except how much money they print. And now we're stuck here at 0% interest rates. We're stuck at $120 billion a month of QE. That's $1.44 trillion worth of what I call counterfeiting. I mean, this really, money is supposed to mean something. If you look at, in the Bible, it says that the money is supposed to be gold and silver. That's what real money is. It's something that represents your labor, capital, human effort to dig something out of the ground. In the case of gold, it lasts almost forever. It's virtually indestructible. Very precious, very beautiful, has utility. So that's money, and it represents real energy and effort to extract an ounce of gold from the ground. What does it take to print, or don't even print, just to hit a keystroke and say, here, 120 billion this month, 120 billion this month, and they take home prices and put them in the stratosphere or the thermosphere, for that matter of fact. First-time home buyers can't afford a home anymore. So, and you say, well, do they engage in yield curve control? Well, they control the short end. They put it at zero, and now they're hoping that they can taper $120 billion a month of QE without causing a disturbance in the bond market. Well, they're going to cause a big disturbance in the bond market, shadow banking system, the repo market, the treasury market, the stock market, the real estate market. I mean, history is very clear. They have distorted markets to such an extent that when they get out of the way or attempt to get out of the way, everything crashes. And it'll happen again, I'm quite sure.
Speaking about bonds, we hear pretty often how China and Japan lead the foreign entities that hold substantial U.S. debt, of course, being treasuries. Now, with the expectations of the US dollar losing value, the outlook of a dollar collapse of sorts, why are these two big bond holders not simply selling off their US debt?
Well, I mean, I think they're we create a, those the U.S. debt is their asset. So if they start panicking and selling the U.S. bond market, and it would go into a tailspin, and their prices would fall too on their assets. So that, it's mutually assured self-destruction. Plus, they still have a trade surplus that they need to recycle somewhere. So they could either let their currencies rise or buy our treasuries. So that's what they end up doing. I mean, they are attenuating that process to some degree. That's for sure. That's been going on for quite some time. But we say, like, dollar collapse. Listen, I guess, I hate to admit it, but I guess I am kind of a gold bug at heart, and a precious metal a lover. But the fact that the idea that the dollar is going to collapse against other fiat currencies, I always thought that was kind of ridiculous. The dollar's value is going to collapse against hard assets. It's collapsing against everything right now. It's collapsing against equities, bonds, real estate, pretty much everything except gold. Gold has been stuck in a malaise for a while because, I guess, in my opinion, looking at the facts and data and history, the gold market is afraid of tapering because the gold market believes that long-term interest rates will skyrocket and the Fed is going to be able to raise rates and the economy is going to soar off into some kind of, Shangri-La land. That's nonsense. I mean, this economy has been predicated on a massive amount of helicopter money that's been monetized by the central bank of the United States. And all that engendered really was a massive increase in consumption. We don't measure gross domestic consumption. We measure gross domestic product. We're not producing many things. If you look at the trade deficit, the United States has the current account deficit as well. It's never been higher. It's record breaking. So you give people consumers a lot of money, $50,000 per household when you add it all up, of modern monetary theory, and then they go out and buy stuff made in China. I mean, I don't know if that's really economic growth. I don't think you would consider that. But it's not, like I said, it's not gross domestic consumption. It's GDP, and I think we've injured that gravely. Listen, we have almost no population growth in this country any longer. I guess X all of the immigrants coming from Central America up through the U.S. southern border. And then we have productivity, which I feel has been injured greatly from what? From the fact that people are being paid or had been being paid to stay home and not produce. So there's a capital goods shortage in this country. We said the durable goods orders, capital goods expenditures are actually falling. We have a tremendous inflation problem in this country right now, which I think is going to morph into a deflationary crisis in 2022. And lack of productivity, lack of population growth, lack of the labor market growth, and you get very, very weak GDP. So that's, I think, we're headed, because don't forget, we've added since COVID, $7.7 trillion of debt. And that's on top of the disabling amount of debt we had before COVID-19 broke out. So the economy has to lug around all of this debt and service all of this debt. That doesn't engender a lot of productivity.
Okay, just want to ask one more question with China and Japan holding so much U.S. debt. Is there a scenario where they could, let's just say, bite the bullet, take the loss, but then move on to a better deal for themselves?
Of course, there's a possibility that they could do that. Of course. And then you might get the Federal Reserve have to step in and say, okay, well, now we're gonna buy every single bond that's issued by the Central Bank of the United States until yields stay below. Let's just pick a number. Two. They like the number 2. The Central Bank of the United States said that we cannot exist as a nation unless inflation is 2%. Right? Well, there's supposed the charter of the 1913 charter for the Federal Reserve said that they had a mandate of stable prices. Okay, stable prices. Now that stable price is now being redefined as 2%. So maybe they cap Treasury, like number two. Maybe they cap the 2-year note, the 10-year note at 2%. Maybe that's the number. But you just can't, in my opinion, you just can't create unlimited amount of money to cap a Treasury yield. You can't create unlimited amounts of inflation and yet keep yields capped at 2%. Because then I ask myself, well, are you going to buy every single 30-year bond? And are you going to buy 2-year note? Are you going to buy mortgage-backed securities? Are you going to buy municipal bonds? Are you going to buy every fixed income asset on the planet? I mean, so when are you going to stop? So I don't really believe in yield curve control. That might be an ancillary function of what happens if China were to just dump all of our treasuries. And the Fed would step in and buy them and then just, stagflate the United States to death. So, it's a possibility.
Okay, so let's say, the bond buyers, the U.S. debt buyers are becoming less and less, and the Fed is pretty much the only game in town, and the government is just simply not collecting enough tax revenues to function. How, in fact, would a government function if it was just basically the Fed and not enough taxes?
Well, we have that now, Patrick. I mean, how much of we had $6 trillion of stimulus between March of 2020 to March of 2021, 6 trillion. How much of that was actually taxed? No, we had tax holidays in this country. The number of families that pay taxes is 107 million U.S. households that don't pay taxes in this country, up from 70 something, 77 million. I forgot the number exactly. So there was tax holidays during COVID. We didn't collect money. We didn't do it the right way. The honest way is to say, okay, the government's going to spend money and we're going to tax you. No, the government didn't do that. The government just spent $6 trillion and the Federal Reserve printed $4.2 trillion of it. So, we're living in a fantasy world right now. And then what happened? Well, inflation that was hopefully supposed to be at 0%, and then the Fed said, well, no, we wanted a 2%. Well, it went to over 5% very quickly. I've always said there's no secret to how to create inflation. I mean, it's amazing. I don't have a PhD in economics, Patrick, but I've been telling these maniac money printers who were like desperately seeking inflation for years and years. Since the Great Recession ended in 2009, they've wanted 2% inflation. They couldn't find it, at least the way they measure it. Oh, we can't get to 2. We can't get to 2. They finally got to 5% inflation, the way they measure it. Producer prices are close to double digits. But the way to get inflation, Patrick, is very simple. You pay consumers money directly so they don't go to work. Okay, now they have plenty of spending power, but there's not the commensurate amount of goods and services to purchase to absorb that excess money. Oh my gosh, we created inflation. Wow, I can't believe we did that. I mean, they have to know this. I mean, how many degrees, how many years of college and graduate school and doctorate school do you need to understand that to create inflation, you need to create a whole bunch of money that just doesn't sit as reserves from primary dealers on Wall Street? No, you give money to people. It's called helicopter money. Modern monetary theory. It worked perfectly. Now we have inflation, gangbusters. But all of that's now going to end. They're going to go, the United States of America, is going to go from a 25% of GDP stimulus package to 2% of GDP in 2022. And that's the important part here, Patrick. It's so important. Like I said, I'm a gold bug. I guess I'm a gold bug at heart. But you have to know when to own these things. You have to know what asset classes, what style factors, what sectors to own, and at what time, and at what weighting. So when do you want to own gold? When real interest rates are falling. So that's your perfect scenario, when they're trying to cap the rise in nominal treasuries. So yields get, there's a weight on top of yields, keeps them lower. At the same time, inflation is rising. So real yields tend to plummet. That's when you want to own gold. Also not so good for the currency, especially as measured against hard assets. So that's when you want to overweight gold.
I want to go back and touch on repos. And back in September 2019, we saw the repo market spike, and today we are seeing 1 trillion plus reverse repos going on daily. Can you help us understand why the repo market has changed course and how this might affect markets or treasuries, if at all?
So all of that is it's actually the reverse repo. It's called the on repo facility. The Fed is printing so much money, $1.44 trillion a year, that banks are loaded with this cash. They don't want this cash. They can't have it. And so they end up parking it back at the Federal Reserve through the on repo market. So the Fed is taking assets, selling them to banks. Banks are holding these treasuries, and then the bank gets the cash. So it's a reverse repo. It's actually draining cash from the banking system because there's so much cash. There's no really market for Fed funds anymore because the banks are so liquid with money. They have all these reserves. They don't know what to do with them. They just park them back. I think it's 0.05% that they're getting at the Federal Reserve, and the Fed's paying them money, and that's better than going in the repo market and doing intra-bank lending, interbank lending. That's what's happening. So that's one of the reasons why I believe that the taper is going to happen, and they're going to disaggregate. They separated the taper from interest rate hikes. So instead of doing this, $1.1 trillion per night of draining money from the banking system, because the banks have reserve requirements, they just can't hold all this money. They have to have equity capital buffers against it. So they're giving the money back to the Fed. The Fed doesn't want to do this on repo facility every night to the point of 1.5, 1.6, 1.7. That's where it's going to go. It's going to go close to $2 trillion, even if they start tapering. By the time they end the taper, it's going to be a massive facility. Then hopefully it'll drain. And by the way, I just want to emphasize the liquidity in the repo market can drain very, very fast. So don't be lulled to sleep saying, "Oh, banks are so liquid, we don't have a problem." That dynamic can change in a matter of days. So, but right now, the Fed wants to drain this liquidity. They want to do it permanently. They want to get rid of it. They don't want this on repo facility to exist, indefinitely. So that's what they're going to do. They're probably going to taper the end of this year. I think Bullard said this morning that he would like to see the taper end by the end of the first quarter of 2022. That's an accelerated taper. Now you're tapering from $1.44 trillion or 120 billion a month. That's greater, far greater than the 85 billion that there was under Ben Bernanke. So that's why I emphasize to people, don't be a stop clock. Understand when to own what asset classes and when to overweight sectors and style factors. It's crucial. Not that I'm perfect. I don't get everything right. But if you can understand this dynamic between inflation and deflation, you'll understand what to own and when not to own something. So for instance, if you had your investment philosophy was, I'm going to buy gold and emerging markets in 2021, you're not doing too well. But that doesn't mean I hate emerging markets. It doesn't mean I hate gold. Like I said, I'm a gold bug at heart. It's just important to understand how important gold is and how important it's going to be in the future and when you're going to definitely need to own it.
The Fed and all this taper talk, let's say they actually go ahead and do it. Are they essentially prepping the markets for the raising of rates, which will then help the Fed out because they'll have to reverse course and lower rates again?
Well, this is absolutely what's going to happen. I think it's ridiculous to assume that there's going to be, like I said before, a gradual easing of monetary asset purchases and a gradual hiking of interest rates, and the economy is going to sail off into the sunset, some kind of nirvana. We understand one function that's very clear. The level of interest rates, the level that interest rates can rise to before chaos breaks out is getting lower and lower and lower. And the simple reason for that is it's twofold. Asset prices are untenable It's an untenable condition to have asset prices at 205% of GDP. I'm talking about stock prices. As interest rates rise towards a normal level of, say, between 4.5% to 6% on the Fed funds rate. You can't get anywhere. You can't get anywhere near there. So it was 2.5% before the Fed blinked in 2019. It was 4.25% before the Great Recession. Or was it 5.25%? I've forgotten now. But it was 6% in 2000, and it was 5.25% or 4.25%. I forgot, but you get the idea. Then it was 2.5% on the Fed funds rate, and now it's going to be something like maybe 1% or less. Maybe we can't even get there because, as I said, it's twofold. The level of asset prices and the amount of debt outstanding cannot tolerate. It's an untenable position to have interest rates rise too far before the whole artificial edifice collapses.
With all these things we've been talking about here, is it time for investors to perhaps be looking at, continue to be looking at making money, or is it time for them to perhaps be looking at trying to protect their money?
Well, I manage money for a living, so I'm always worried about, and I have my own money, some of my own money here too, at the in the IDEX strategy, the inflation, deflation, economic cycle model, which I created. So it's very important. It's imperative always to worry about protecting your assets. So this is the whole reason why I created the strategy, because I said to myself years and years ago, I said I'd like to participate in this maniacal market, but I'm so scared about it blowing up. How do I do that? So I created a model to let me know when Wall Street is about to care. So when Wall Street, when the people who manage money on Wall Street, the trillions of dollars of money managed on Wall Street starts to care, and there are things you can look at. So I look at recessions and credit crises. Those are the two things you have to worry about when you're going to get a protracted and dramatic and significant drawdown of asset prices. Those are the two things that could really, really wreck your retirement. So I'm not talking about a 5 or 10% correction. I don't know when they're coming. You don't know when they're coming. Nobody knows when they're coming. They just happen, and they're innocuous in a bull market. You can't worry about it. But what I need to worry about is the 30, 50, 80% drawdowns that happen. Happened in the United States. NASDAQ lost 80% from 2001 to 2003. It's happened in China. It's happened in Japan. In fact, those economies have never recovered. Those markets have never even come close to recovering. China peaked in 2007. Japan peaked in 1989. And not even close to recovering in those command and control economies and central banks. So I need to avoid those drawdowns that are engendered from credit crises and recessions. And I can predict that with my model, which gives me the confidence to ride these bubbles higher in the correct sector. So again, I need to know, am I long cyclicals or am I long growth? Am I on banks and yield curve expanders and inflation hedges, or am I hedged for disinflation and bond-like proxies? So I have to know that. And that gives me the ability to ride these bubbles higher in a more safe manner and in the correct manner. So right now, guess what? The model's not saying that I should be out of the stock market right now. It's beginning, so there's the initial stages of maybe so there's red and there's amber, there's green, but there's maybe a little bit of amber creeping into credit markets right now. So I'll give you one of my models components is the high yield, the junk bond spread to treasury spread. So that's starting to blow out a little bit. I'm watching that very closely. That's one of the things. So you look at a series, this model is 20 points. It's a 20-point model. And when all those things start to, they tend to give me many different factors that are in alignment. And if I see them start to say, wait a second, there's problems in the credit market starting to come to the fore, then I know it's not just a regular 5% correction coming. It's something much, much worse potentially, and I need to hedge against that. So that's when I call it the four horsemen of the apocalypse: cash, short-term treasuries, long the dollar, because when the global economy has a crisis, people have to cancel their carry trades, their dollar shorts. So everybody runs to the dollar, short-term treasuries. Happened over and over again. Happened in COVID. Happened in 2008. It happened in 2000. It's just something that always has happened. It might not always be the case, but it's always happened in the past. And then I also short stocks. I go long investments that profit when the market goes down. So those are the four horses of the apocalypse.
Okay, so just to be clear on what you had mentioned earlier, the dollar may have a sort of collapse against assets, but not against other currencies.
That's exactly what's happening. Exactly what's happening. Do you know, I'm one of the only people that you'll probably interview on your channel that's been long the dollar since March. And it's not because I love the dollar. Dollar's being counterfeited to smithereens, but is it any real different in Europe or Japan or China? So what the dollar is going down against is the stuff I own, which is, utility stocks having a great year so far. For example, Walmart, one of the things that I own in the portfolio, because I have switched to more of a bond and bond proxy defensive strategy, because I don't think, my opinion, models tell me that disinflation is happening now and towards the end of the year, which could become deflation as the Fed aggressively exits their taper. Of course, listen, and I'm here, this is the thing, I'm willing to change. I'm here every day modeling the economy, looking at the data, and making decisions as to where I put my money. So that's the predicate right now, but as I said, it's subject to change. But I would not be surprised. That's the base case scenario. Think about the comparisons between the second quarter of 2022 to 2021. Ooh, baby. Those are some rough base effects. And it's probably, you're probably going to have an economy that's already rapidly slowing, not a recession, just a second derivative change. So instead of growing at 6% or 8%, whatever number they came up with, it's going to be 2. So the economy is already growing, but growing at a slower rate, second derivative. Guess what? That's when the Fed will be aggressively tapering and threatening to hike rates. That's perfect prescription for the stock market to melt down. And guess what happens when the stock market melts down? The junk bond market melts down. The real estate market melts down. The repo market freezes. All those happy things happen at the same time. Now, do I sit here and say, I'm going to give you my end of 2022 price target for the S&P 500? No, you don't. You don't know. So you shouldn't even guess. But you could say clearly that, inflation will be slowing, growth will be slowing, and I think I should own these asset classes and be cognizant and aware of a recession or a credit crisis, so I can make moves to profit from that. Listen, I manage money for a living. Is it wrong to try to make money and protect your clients when things go south? I don't think so. But by the way, Patrick, the faster this happens, the faster this great reconciliation, healing process happens, the better off it will be. Because guess what? People will be able to own a home again at a reasonable price. They can invest in the stock market without getting killed and worry about the stock market melting down. Maybe, Patrick, they can put money in the bank that they saved and earn an interest rate that's positive. All these crazy thoughts. But that's where we want to. I would assume even the Federal Reserve would like to someday see that happen. But that's going to happen only after a very painful period. And you know what? And I'm hoping and praying that the Central Bank of the United States says and in a sense, an acquiescence to that notion, because if they say, oh, the stock market's down 30%, let's reopen the spigots and let's start printing like maniacs. Well, I'll change my investment philosophy for stagflation from disinflation, deflation, stagflation. But do you think that that's going to, I mean, is that a viable prescription when Wall Street becomes aware that the central bank can never stop printing trillions of dollars every year to finance modern monetary theory? Wow, you're talking about, Venezuela. So, yeah, don't be a stopped clock. That's my advice.
Okay, last question here. I can hear people asking me, Patrick, why didn't you ask Michael Pento this? Gold and silver, why are these two assets having such a hard time against the U.S. dollar?
Because they are afraid that the taper tantrum is going to happen and nominal yields are going to spike. And that means that real interest rates are going to rise. And that means the dollar will rise as well. And they're afraid of that. And to be honest with you, I mean, I sold all my gold in August of 21. I bought back, I had a 5% position for a little while earlier this year. I took the 5% position down to a 3% position in the portfolio because I know, I mean, listen, it's not a mystery. Go and back test what gold did in the last taper. It didn't do very well. Gold's going to do well when the economy slows significantly enough that everybody knows that the taper is going to be, the fear of higher rates is over. That's the answer. Fear of higher nominal rates ends, and the fear of falling real interest rates is very real. That's when you want to overweight gold. So I'll take gold from where it is in my portfolio at 3% to 20%. But I want to do it when it's very clear that the economy is slowing. It's not happening yet. Right now, what are you hearing? Labor market is healing. Economy is booming. Reopening of the economy, as if it didn't reopen yet. The economy is reopening, and we're gonna taper our asset purchases, which is deflationary, and we're gonna raise interest rates, which is deflationary. So when you add higher nominal rates and then deflation adds to that, right? Inflation subtracts from nominal rates to get a real interest rate. When you have deflation, real interest rates are higher than nominal rates. That's what they're worried about now. That's what they think is going to happen. But when that notion, when Wall Street is disabused of that notion, then you'll see gold. I believe the gold market will just skyrocket.
All right, we're kind of looking for that to happen. Always enjoyable speaking with you, Michael. But before we wrap up, can you let our viewers know more about where they can find you, what Pento Portfolio Strategies is, and of course, tell us about lunch break.
So Pento Portfolio Strategies is an SEC registered RIA firm. We manage money in the IDEX strategy, inflation, deflation, economic cycle strategy. If you have around $100,000 to invest, I will personally put you in that model. So you'll have an separate account at Charles Schwab Institutional. You'll see everything I do 24 hours a day, 7 days a week. You just put me on as your manager, and I'll take care of that for you. If you don't have that, you can always go to the website and get a free trial subscription to the midweek reality check, 5-week free trial, and that gives you some of my thoughts every week. That's less than $50, slightly less than $50 a year. And the lunch break, which I thank you for noticing, I just think it's important. Not that you should never, when you give something to somebody, you don't brag about it. You just do it. But I thought it's also important to understand that people should understand that when you reach to a certain level in your life, you've got to reach behind you and pull other people up. So it's always important for people to understand you have to help other people. So that's why it's on my website that we donate to various charities. Again, it's not, I don't mention that unless you mentioned it, but not to brag about me. It's important that people know how important it is to always give back.
Michael, we want to thank you for your time, and I hope we can do this again soon. And many of us, we are going to need help with decisions that are upcoming. So we thank you for that.
And I thank you, Patrick. Take care.
That was Michael Pento, president and founder of Pento Portfolio Strategies. For more of Michael's views and services, please visit www.pentoport.com. and Twitter at Michael Pento. If you like this video, please give it a thumbs up and subscribe to the SBTV channel. Audio-only versions can be found on iTunes and Spotify.